Hello, this is Mrs. Puentes, Hudson Valley's class, QBA. This is the last unit, Unit 7, on bonds. So I would like you to pull out your handout or have that printed out. You should review the PowerPoints and always have your formula sheet handy. Now, in bonds, they're a little bit different from the other chapters. There's quite a few definitions, and definitions will be required for you to know for the test. So I am going to go over some of the words that are on your handout, and the definitions are in PowerPoint. But before we do that, I would like you to, I'm going to jump over to the video, and that is a video to introduce bonds. So I'd like you to copy and paste that into your browser and spend about 10 minutes reviewing this video on bonds. It's a short, simple explanation on bonds. So pause it here. You're back. So let's look at some definitions. A bond. A bond is a long-term debt that pays interest and matures at the end of the term, similar to a promissory note. Can be issued by a corporation or a government. Typically, governments, it's a municipality, we call it. Bond is a security. That means you can sell and buy them. Bonds are affected by time, credit of issuer, the person issuing it, and the current interest rate when you're selling it. Typically, when the overall economy increases, when you have a good economy, bonds values decrease. And the opposite is true. When the economy is in a downward trend, bonds interest rate increase. The coupon part about the bond guarantees interest paid on the bond in an interval. The coupon is actually an annuity. Redemption value, the maturity value at the end of its term, usually called the face value. The amount the holder originally paid for the bond could be more or less than the face value when purchased. Now, and I'm going to go back, if a corporation issues a bunch of bonds, they have to, and I mentioned this in the last unit, they have to have a sinking fund because they know if the bond term is 10 years, they know in 10 years they're going to have to pay many, many bonds back. So by law, and it's highly regulated, they have to sink funds into an account so at the end of 10 years they can pay all the bondholders back their money. So let's look at some more definitions. Now, information on a bond is typically the face value, the issuing corporation or the municipality, the bond rate or the coupon rate, and the maturity value. And there's also information, serial number, terms, the trustee that's managing it. There's several different types of bonds, but two general categories. There's a secure bond. A secure bond is secured by an asset. It might be the asset of a building or a mortgage bond, meaning if they default, they can sell the building and they can pay back the bondholders. So that's a secure bond. Many bonds are debenture bonds or unsecured. Okay, they have no collateral, just the good name of the issuer who issued the bonds. You know, if IBM issues a bond, it's more secure. If a startup company issues a bond, well, it's not so secure. Some bonds have an option to convert it. In other words, in a certain period of time, you can take your bond. A bond is a liability to the corporation. Okay? And as you heard from the video, if the company does very well or does very poorly, it doesn't affect the bond because the bond is a liability that they have to pay a certain interest rate over a certain period. Well, the bondholder may want to be able to convert it. In other words, change the bond into stock. Stock is it's an asset to the corporation. You own part of the corporation when you have a stock, and we'll go over that in a few minutes. Zero coupon bonds or discounted bonds. They pay no interest, but they're purchased at a discount, maybe for $900, and then at the end of the term, you're given $1,000. Therefore, the interest rate is used to discount it at maturity. A callable bond, we're going to discuss that in one of the problems, is a bond that the issuer has the right to buy it back. Okay? So you buy the bond today, and the bond is maybe 10 years the term. At 5 years, the issuer or the corporation says, you know what, I want to buy back the bond. I have the option, or it's a callable bond, to buy that bond back. And because of that, they will pay you a premium for the bond. If it's a $1,000 bond, they might pay you $1,050 because you wanted to hold on to the bond for 10 years, and they say, nope, I have the option to buy it back because I want to reduce my debt. Why would they want to reduce their debt? Maybe they want to buy something else. Maybe they want to merge with a company. Maybe they want to buy a company. So they will reduce their debt by paying back. They have the option to call their bond in. Municipal bonds are issued by a government. It could be local, state, federal, and they are exempt from federal tax. It's a big advantage. So therefore, municipal bonds are usually offered at a lower interest rate. They pay you a lower interest rate because they know you're not going to have to pay federal tax. So if you have the option of a municipal bond at 4%, an IBM bond at 5%, it's more cost effective to buy the municipal bond because you're not paying that 20% federal tax on your increase in value. Other securities besides bonds are stocks, options, and commodities. Now, mutual funds are also listed here. Mutual funds is a very good option for people to purchase. Mutual funds are a combination of maybe stocks and bonds, maybe secure bonds and more risky stocks. And together, in one, you buy a share of that mutual fund. Its risk is minimal. Everything has risk. Remember that. Bonds, stocks, option, commodities all have risk. But you can minimize your risk by buying a group of stocks in a mutual fund or a group of bonds in a mutual fund. Or maybe you want to invest in international markets. So you buy a group of a mutual fund that invests in international funds. Stock, and this is important, you should know this definition, is an part ownership of a corporation, and it's divided into shares. You buy shares. Stocks are generally thought to be very liquid, meaning liquid means you can turn them over to cash very quickly. The two types of stocks that you're required to know in this class are common stock, which you own a share of the company and usually receive dividends and capital gains. There's two parts. You may want to buy a stock to get a quarterly dividend. You want the income. That's one type of stock you could invest in. You could invest in another type of stock where you don't get any dividend or a very small dividend, but you expect it to capital gain. You expect the stock value to increase. Or you can get a combination of both dividend and capital gains. Preferred stock, stockholders are paid first. And these are usually sold only in large quantities. A broker would buy and sell these. Now, if you go to my PowerPoints, there's advantages. Say if a company goes bankrupt, there is a legal list of how debt is paid. The first people that are paid are the bondholders because they are a bill that the company owns. They are not part of the ownership. Okay, the next bondholders are paid first, preferred stock paid second, And if there's any money left over, then the common stocks are paid. Another definition is IPO. IPO is first time offering of a stock. So typically a company is privately owned. Facebook was privately owned for years and years and years. And a few years ago, they decided to offer it as a public company. And it takes a lot of paperwork and the government gets involved. And then they offered it for all people to buy. And that first time offering of stock is called IPO, or initial price offering. A company has to also annually issue a prospectus, which is the disclosure of the company's finances. An option is a person has the option to receive stock, commodities, or goods or services. And investment bankers are the people that determine the interest rate on a bond. You don't determine your own interest rate. And they're very large. Investment bankers, you don't go to KeyBank and find an investment banker. You have to go into an investment bank. And they find buyers, and these are large companies that will buy your bonds and look at your credit. Now, I would like you, I'm going to jump back over to the screen. And you might want to copy and paste this stock link into your browser. And then there's a mutual fund that I also recommend. Now, in this slide, I say risk is the potential variability in cash flow. All securities have risk. Stocks, bonds, mutual funds, all have risk. Dollar cost averaging, what happens is if you work for a company on a regular basis will allow you to purchase stock. Well, you might purchase this month for $10, next month for $12, next month for $8. So they have to have a dollar cost averaging to average the stocks. So I'd like you to pause now and look at if you buy a stock for $50, sell it for $100, you received 100% return. And I'd like you to get these two answers. Bull market is an optimistic market, bear market, pessimistic. So if I back here, $50, sell it for $75, I have a 50% return on my investment. If I bought it for $50 and sell it for $40, I've lost 20% on my investment. I'd like you to look at this. These are the symbols for a formula. We're going to start. And I'm going to skip this slide 11. I'm going to go to this slide. Bonds. You need two things to value a bond. Oh, no, I'm going to go back to 11. There's two things on a bond valuation. A bond pays a coupon. Let's say this is an annual, pays annually 15% on a $1,000 bond. So at the end of every year, they're going to pay you $150 on the bond. At the end of the 30-year bond, at the end of the term, they're going to return that $1,000 to you. Okay? So there's two parts when you value a bond. There's the annuity part on the previous slide, that $150. And then there's the compound interest part, or that $1,000. We're looking for a present value of the bond. So I'm going to do an example. This is an annual bond. It pays annually, $150 annually. And I'm going to use this formula right here. N is always, you always go from 30 years, you're finding a present value. If I find the value to buy it today, I am looking at the $150, here's the part of the formula that values the $150 annuity today. And here I'm circling the formula that values the $1,000 today. I'd like you to pause it to find out the givens and substituted it and try to do it on your calculator yourself. But you'll find out the price I should pay for that bond is $1,000 today, which is correct. The next bond, it's very similar except it's paid semi-annually. And I want to emphasize, in this class, we will only do $1,000 bonds that are paid semi-annually. We will never see annual bonds again. So here, we are paying $75 every 6 months. Now, very important, when you do have a bond problem, the first thing you're going to do is calculate, right here, the payment, and in your formula sheet, it's the $1,000 times I, which in this case is 15% divided by 2, so our payment is $75. Okay? Once we calculate the coupon value, or the $75, we will never use the 15% again. Okay? I'm going to go on to allow you to read this. Now we're going to calculate some bonds. So we're going to find the present value of a $1,000 bond, 15% coupon, semi-annually. On the previous slides, we found the payment $75. After 1 year, after I've held the bond for 1 year, money is worth 10% now. When you do a bond, you're always finding the present value. So you have to determine how many payments are left. In this 30-year bond, there were a total of 60 payments, 30 times 2. But we're 1 year into the bond, or we've already paid 2 payments, so we have 58 payments left. 58 is your end value. 58 is your end value. And now we use the 10%. We don't use this 15% again. It's only used for the payment. So we substitute the payment of $75, 58 periods left, the $1,000 bond, 58 periods left, the value of the bond 1 year into its life when money's worth 10% is $1,470.49. Now let's think about this. We have a bond, and we have this something like a note that I promised to pay 15%. I go to the bank, and the money's only worth 10% now. So the bank thinks, hey, this is great. I'm going to get a promise to pay 15%, yet right now money's only worth 10%. So the bank is willing to pay more than the $1,000 for the bond. They're buying it at a premium. Let's find one where they're at a discount. Value of a $1,000 bond, 8% coupon rate. So we're going to use the 8% to calculate the payment. It's purchased 3 years before maturity, and now market rate is 9%. The yield, by the way, is sometimes referred 9% basis. Use the coupon rate for payment calculation only. So the first thing, and you'll see that on your formula sheet. Right here, I always say find the coupon. Here in the bond, I said first find the coupon value, maturity value times I. By the way, here is your bond valuation formula right here. And your other formula we're going to use in a few minutes is year to maturity. So, $1,000 bond, 8% semi-annually to, our payment is $40. We have 3 years left on the bond, times 2, 6 payments left. You can substitute it in your bond valuation formula, and you can sell your bond for $974.21. It's sold at a discount. Why? Well, you're only getting 8% on the bond, and you want to sell it to the bank when money's worth 9%. The bank's not going to want that bond. They can get 9% on investments. So you have to sell it at a discount or something less than $1,000 to be marketable. Number 5, this one I'm going to let you do by yourself. It's a little tricky, counting how many periods are left. Now I'd like to talk about a callable bond. Remember, I mentioned a company that issued the bond. If it's a 30-year bond, maybe at 10 years they want to call the bond in. In other words, they want to pay you their debt for the bond. They will pay you a premium. In this question, it says it will be called at 105.05. That is a percentage. You take that number and multiply it by 1,000. You turn that percentage right there into 1.0505 into a decimal form. You multiply it by 1,000, and therefore the bond's value is $1,050. It's face value. It's not 1,000 anymore because they have the right to call it. So they're giving you a premium for it. So you want to sell this bond on 10/1/89. The issuer of the bond can call it or pay it off on April 1st, 95. So the bond value isn't worth 1,000, it's worth $1,050. So we have to find out how many periods are between 10/1/89 and 4/1/95, and we find out there's 11 right here. I'll give you a minute to pause. There's 11. And therefore, when I forgot to do the very first thing, is you always calculate the payment. $1,000 times 8 5/8% divided by 2, my payment is $43.13. $43.13. We have 11 periods left. Now this time, when a bond is callable, we don't say the maturity value is 1,000. It's $1,050.50 because it's a callable bond. When you do this, the value of the bond is $1,060.22. Here is another callable bond you can do, and pause. Payment differential method. Now you might want to be careful and look at my emails or my announcements. Sometimes I include payment differential method in the syllabus in our class, and sometimes I don't. I will go over it. This question says, use the payment differential method to determine the value of a bond on 8/1/05 of a $1,000 9.5 bond paid semi-annually and due on 2/1/20 if the yield is 8%. Okay. Well, the first thing you're going to do is find the actual payment. Remember, I always said that. Actual payment, 1,000 times 9.5 divided by 2. The payment was $47.50. Okay? Now that we're here on 8/1/05, money's not worth 9.5%, it's worth 8%. So let's suppose I bought it today, I would have a required payment of only $40 because money's only worth 8%. Okay? So if I bought the bond today, I'd only get a payment of $40. But I do have this note or this bond that says it's going to pay $47.50. So the difference in this is $7.50. This is what I'm actually getting. This is what I should get. So I'm getting a plus $7.50. Okay, let's find the total payments left on the bond. There's 29 total payments. Okay, so this is the payment differential way of doing it. I am just going to take the annuity, the payment, and I'm going to say I should be getting, I'm going to get $7.50 more than the market value for 29 periods. So I'm going that $7.50 over the 29 period is valued $127.38. I am just going to add that on to the bond of $1,000, and my purchase price of the bond is $1,127.38. So I only took the differences between the payments, what I'm getting and what I should get, and I found the present value of that and added it on to 1,000. And you can check that by sticking it in your original formula. This is another payment differential problem, except it's a loss. It's a discount. I get $30, but money's worth, and because I'm getting 6% interest, but when I want to turn it in, I should be getting 8% interest, or I should be getting a bond that's worth $40, so I'm losing $10. I can find the loss of this $10 is negative $135.90, and if I subtract it from 1,000, I'm buying the discount at a discount. I'm buying the bond at a discount. This topic, buying bonds between coupon dates. You have to interpolate, determine the quoted price, and total results of step 1 and 2. Okay? Let's look at an example. A little complicated. $1,000, 6% bond with interest payable on June 1st and December 1st matures on June 1st, 2015. The bond is purchased on October 1st, 2013 to yield 8% converted semi-annually. What is the total purchase price of the bond? Okay, so we purchased the bond right here on 10/1. Or let's say we want to sell it right here. It's in between coupon dates. There's a coupon date of 6/1 and a coupon date of 12/1. The first thing you always do is calculate the payment. 1,000 times 6% divided by 2, payment is $30. Okay. Well, I'm going to sell the bond right here. They're going to pay a $30 coupon on December 1st. I own the bond for 4 out of the total 6 months. So I deserve part of that coupon. So the $30, I owned it 4 out of 6 months. I accrued $20 of that $30. So I should get $20 and the new owner only gets $10 of it. Okay? It's paid right here. So he better give me the $20. Now, the next step is we're going to find the value of the bond before we sell it, the value of the bond after we sell it. Here, we have 4 payments left. Here, we have 3 payments left. So here we have the value of A and B before and after. If I subtract those 2 numbers, the value of the bond increased $8.55. It went from value here to here, $8.55. Well, I am allowed to, I held the bond for 4 out of 6 months. So I'm entitled to part of this $8.50. How much? 4 out of 6 months. So if I multiply 4 divided by 6, I'm entitled to $5.70 because I own the bond for these 4 months. So if I take the initial value of the bond at VA, which is $963.70, I'm entitled to the increase in value of the bond for 4 months, $5.70. I'm also entitled to $20 of the coupon because I owned it for that period. So the purchase price is $989.40. I have another number 10 is the same thing, except it's a loss. The last thing I'd like to go over is yield to maturity. Yield to maturity formula is on your formula sheet. It's much better on your formula sheet than it is in my PowerPoint presentation. M is the maturity value, which is always 1,000 in this class. V is the value or the price of the bond. So you had a $1,000 bond, you handed it into the bank, and they gave you some money. And you're wondering, what interest rate did I get? So you use this formula. This formula is only for semi-annual payments. So let's look at this. A $1,000 5 3/8 bond semi-annually matures at par in 6 years. If the bond is purchased for $935, what's the nominal yield rate? You find payment and N. Always find payment first, $26.88, okay? And 6 years, 6 times 2 is 12. You substitute into this formula your payment, your maturity value of 1,000, the value you bought it or purchase price, $935, and N is 12. Divided by maturity value 2 plus the purchase price divided by 3, you're getting 6.75 yield. There's another question here that you can pause and do. The tricky part is determining the number of periods. Okay, so I jumped over several problems in this chapter. You are to do all the problems so you know if there's a loss or a gain. And again, if you have questions, the best way is to email me, or you can give me a call on my work phone. I will get back to you, and you can come and see me always during my office hour. Thank you very much, and good luck.